Trading or investing. Same money, same return, 25 years. One ends near 760,000, the other 260.
Trading and investing get talked about like the variations of the same thing. They're not. They answer different questions, demand different temperaments, and produce wildly different end states, even when the gross returns look identical. The cleanest way to tell them apart isn't risk, isn't return, isn't even strategy. It's holding period. An investor buys a productive asset and intends to hold it. Years, decades. The thesis is that the asset's underlying economics, earnings, dividends, cash flow, coupons, deliver a return over time. Short-term price wobbles are noise. A trader buys with the explicit intent of closing at a specific price level, sometimes minutes, sometimes weeks. The thesis isn't about whether the European economy is structurally healthier than the US one. It's about whether euro-dollars breaks 10900 before it hits 10750. That single difference cascades through everything else: edge, costs, taxes, behavior. The investor's edge is patience. Most of the market is forced to manage short-term performance. Fund managers tracked quarterly, retail traders watching daily moves. The patient owner rides out drawdowns that others have to sell into. Compounding does the work. The trader's edge has to come from somewhere specific: speed, information, discipline, pattern recognition. High-frequency firms compete on microseconds. Institutional desks pay for satellite imagery, credit card data, supply chain feeds. The retail trader, most of the time, doesn't have any of those. Hold that thought. There's a number that tells you exactly how that fight tends to end. Across the EU and UK, regulators require brokers to disclose how many of their retail CFD and Forex accounts lose money each quarter. The number sits between 70 and 85% every quarter since 2018. It hasn't improved with leverage caps. It hasn't improved with negative balance protection. It hasn't improved with risk warnings stamped on every broker's homepage. Australia's regulator found the same range, 70 to 80% loss rates among retail CFD clients. And it's not just CFDs. The 2000 Barber-Odean study analyzed 66,465 U.S. household brokerage accounts over 5 years. The most active 20% of traders underperformed the least active by about 7 percentage points per year, mostly from transaction costs. 7 points per year, compounded. A Taiwan day trader study from 2014 found less than 1% of day traders earn predictably positive returns net of fees over extended horizons. The S&P SPIVA scorecard shows the majority of professional active fund managers fail to beat their benchmark over a decade. These aren't retail amateurs. These are people who do this for a living, and most of them still lose to a boring index fund. None of that proves nobody can trade profitably. It proves the average outcome is poor. So where does that 7-point gap actually come from? 2 places: costs and taxes. Index investing costs almost nothing. Expense ratios run between 0.03 and 0.20% per year, a few basis points of bid-ask spread at entry. Custody fees are usually zero. All in, a long-term investor pays maybe 0.1 to 0.5% per year. Over 30 years, total drag is a few percent of total return. Meaningful, but small. Trading costs are a different animal entirely. Every round trip pays spread plus commission. Leveraged positions accrue overnight financing. Every closing trade triggers a tax event. And the time spent making decisions, that's a cost too, even if no statement shows it. Run the math on a frequent Forex trader. 5 round trips per day, half pip spread on majors, $3 commission per side. That's easily 50 to 100% of starting capital and turnover costs every year. To net 10% profit after costs, gross returns have to be enormous. The academic evidence says that level of gross outperformance is rare. Here's the thing about costs. They compound just like returns, but in the wrong direction. A 4% annual cost drag doesn't just take 4% of your money. Over 25 years, it changes the shape of the curve entirely. We'll come back to exactly what that means in dollars, but first, the second leak: taxes. In the US, hold a stock for more than 12 months and you pay long-term capital gains, 0, 15, or 20% depending on your bracket. Hold it less than 12 months and you pay ordinary income, up to 37%. That's not a small gap. That's the short-term trading penalty, written directly into the tax code. And every closing trade is a realization. Every realization is a tax event. Compounding inside a single, never-sold position is structurally more efficient than realizing small gains over and over. In the UK, CFDs are taxable above the annual exemption. Spread bets are exempt, but the spreads themselves are wider. You pay the tax invisibly, through pricing. In Germany, the flat 25% Abgeltungssteuer applies, plus solidarity surcharge, and loss offset rules for traders have been rewritten multiple times in the past decade, usually unfavorably. Layer the sheltered wrappers on top. 401k and IRA in the US, ISA and SIP in the UK, PEA in France. Long-term investing inside one of those wrappers can be dramatically more efficient than trading the same capital in a taxable account. That's not opinion, that's arithmetic. Speaking of arithmetic, let's actually run the numbers. Two 35-year-olds each contributes $1,000 a month for 25 years, same 7% gross annual return on both sides. One puts it in a US total market index fund. One trades actively in a margin account. The investor ends with roughly $760,000 in real terms. The trader ends with roughly $260,000. Read that again. Same starting capital, same gross return, same time horizon. The trader ends with about a third of what the investor has. Where did the $500,000 go? Trading costs eat 4% per year. Short-term capital gains tax takes 30% of net income on top. Compound both of those over 25 years and a $500,000 gap opens up. This is the mechanism behind every loss rate statistic so far. Trading isn't a substitute for investing. Even if you match the index gross, you lose the race to costs and taxes. That's the math. Now what do you actually do with it? If you're starting from zero, the order of operations is brutally simple. First, build an emergency cushion, 3 to 6 months of expenses and cash equivalents. Second, max out tax-sheltered investing in low-cost, diversified index funds. That is the highest expected value move for almost every retail participant alive. Only then consider a trading account. Fund it with money you can afford to lose entirely. The first year is tuition, not income. If you're already trading without an investing core, ask yourself one question. Over the last 12 months, on real money, have you beaten what a boring index fund would have done? If you can't show that, the rational response is to redirect most capital into the investing portfolio and keep trading at learning scale. Invest when your horizon is years to decades, when you won't check positions weekly, when you can do nothing during a 30% drawdown. Trade when you have a journaled edge, when the capital is genuinely risk tolerant, when you can place rules-based exits without flinching. Remember the number that tells you how this fight tends to end. 70 to 85% of retail traders lose money every quarter. That's not a warning sticker, that's the baseline outcome. Most retail participants should be 90% investor, 10% trader, at most. Some should be 100% investor. Very few should ever flip that ratio. Use both, in the right proportions. That's how you avoid the worst outcomes of either.
Investing wins on math. Trading wins on edge. You've actually proven. Full breakdown linked in the description.